Today, folks, when it comes to these YieldMax covered call clown chasing finfluencers like passive income investing, better call Paul. Poor Gary Gill, we're drinking his tears, losing $97,000 on MSTY. I feel as though they did not have a daddy to spank them when they were misbehaving. So now that they're going to be in the real world, they're getting spanked by a reality. And unfortunately, to the uninitiated, I don't want that to be you. I don't want you to have to get spanked. So let me be your daddy. Let me Jesus Christ. Woosah here. Let's get this train back on the tracks, folks. Now, look, I don't consider myself any more of a dividend investor than I do a growth investor. In fact, I believe they're two wings of the same damn bird, just like the left and right here, folks. And I'm just looking for the path of least resistance to fast-tracking my financial independence without taking on like an exuberated amount of risk and detrimenting my time frame to that retirement goal. And honestly, when I talk to these covered call investors, they don't know what they're doing. If they did, they would explain a strategy behind it. They would talk about cash secured puts. It's a counterintuitive statement to say, hey, I'm long crypto, I'm long tech stock, so I'm going to get my exposure through covered call ETFs. And if you can't figure out why that sentence doesn't make sense, don't worry. I'm going to explain it in a way you might not have heard before in this video. But in this day and age where you have access to the most expensive supercomputers in the damn world, artificial general intelligence, and you ask it, is it a good idea to write covered calls against highly volatile assets? The most direct answer, guys, is no. It generally is not considered a good idea for the common objective of covered call writers. And I'm going to explain to you why this is and why YieldMax and like these really high yield, high volatile stock option ETFs are kind of taking advantage of your psychology. And I'm not going to call them a scam because they're perfectly legal products. But the reality is they fundamentally know what they're doing, and they're tackling an audience that is just income oriented, is just trying to cover their basic expense, and a lot of time just handing back their own capital to them, knowing that this is not an appropriate way to write covered calls. In fact, it's a super detrimented way. But firstly, we got to drink some tears. You know, cheers. I told you guys the day was coming. You know, daddy wasn't there to beat them, so reality is going to beat them instead here, guys. So we're going to drink some tears. And ironically, I think I'm actually on with Gary Gill next week. And I hope he can have a little bit of fun with this because, like I said, guys, like I'm hyperbolic. I poke fun at people. This is for entertainment value. For some reason, I'm the only one that can admit that he's a finfluencer clown in full transparency and show his real portfolio and his real returns and be honest about it. Again, guys, my actualized returns come nowhere near close to what these covered calls are promising, like these YieldMax ETFs for dividends. And those fundamentals don't even match my total returns, which I think is, again, laughable and manipulative at best. But regardless, it'll be fun to talk to Gary Gill about MSTY perhaps. But I've seen Jeff here, another guy, saying he sold 15,000 shares of ULTY, 20% off. After 14 weeks of holding, I think Monday we will unload. Instead of repositioning, I will sit on the cash and see if the market crashes. Anyone else think this is a good idea? Anyone think I should hold? This guy's not a good investor. You should always be cost averaging into the broader markets. If you think you know when the markets are going to crash, you are an absolute beliterate clown, and you haven't been slapped upside the head hard enough yet to realize that. So moving on here, we have another gentleman here saying he's holding MSTY at a 54% loss. Okay, listen, most people panic when their stocks hit 10%. Some panic when it's down 20%. The wise panic at minus 30%. Okay. Then there's me, proudly sitting on a minus 50% on MSTY, the true call of a degenerate. I feel like Blossom has become like the degeneracy for like income investors, the same way like speculations on like GameStop and short squeezes was like, a Reddit. But sipping water like it's champagne. But guess what? I'm not afraid, not even close, because every portfolio needs that one stock that humbles you, teaches you patience. You really don't. And makes you question your life choices. That sounds like a great way to collect cash flow. I always feel like these guys are so income oriented to get stability in early retirement, and they're chasing like the craziest shit in the market, but also becomes your favorite comeback story. This will not be a comeback story. I'm sorry. And honestly, if I survive 2022 crypto dips, 2023 inflation fears, and the 2024 market mood swings, you think one small minus 50% is going to scare me? Nope. I'm just built different. I'm built like a long-term investor holding a lottery ticket. So it's interesting because these are the statements I don't understand, because if you're built like a long-term investor holding a lottery ticket, why are you giving somebody the right to buy that lottery ticket from you if the lottery ticket pays off? That's literally what you're doing here. Don't worry, I'm going to break it down a lot more simply, but he says, so here I am, down bad, still holding, still smiling, still believing in the comeback season. No, you don't, because you're doing it through covered calls. Because one green day will erase 10 red days. No, it won't, because you're holding covered calls. And I'm patiently waiting for the day like it's the season finale of my favorite show, and that show will never come because you're doing it through covered calls. To all my fellow investors holding the red bag, stay strong, stay calm, stay unbothered. We might be down, but we're not out. So the problem that I have is I really want to just kind of try and simplify this as much as humanly possible, and why companies like YieldMax have really found these intelligent ways to take advantage of investors that, again, just are super hyper unaware of the strategies of covered calls. Or again, they would talk about cash secured puts. They talk about other option strategies when these strategies make the most sense, because these guys just figured out something brilliant that a lot of investors do not care about doing the strategy as much as they care about collecting the premium. So let's just do the strategy nonstop, even when it doesn't make sense, right? So what is a covered call? I mean, let's just try and explain this as simply as humanly possible, because Google and other people do just a disservice to the community by trying to explain this. It's a very complicated structure when you try and go through like these graphs, but it's not fundamentally. And let me explain to you here. So got to full screen this. Sit down, take a breath. Let's do this very simply, guys. A covered call is simply me owning some shares in a stock like Google and giving you the right to buy my Google shares at a certain price in the future. And for the right to buy those shares, you are going to pay me a fee, or what is called a premium. So why would somebody want to do that? Well, first let's just talk about the benefit of somebody that wants to buy and give me those fees to do so. That person is basically saying, hey, if I think Google is going to go to the moon in the future, a little bit higher from here, I would like the right to buy those shares from you, and I will give you that fee to do so. But if the stock absolutely tanks, I don't have any exposure to it. You have all the downside risk. I don't. But let's say Google absolutely skyrockets within a certain time frame, and I'm locked in with you at a certain price to buy those shares. Well, guess what? I'm definitely going to take those shares off your hand. I'm going to give you cash at the price we agreed, and I'm going to take those shares, and then I'm going to sell them for what they're worth at the market price to collect that profit. And I can do that without taking any downside risk, but while paying you a small fee to do so. So from my perspective, you have to ask, why would I want to sell you those shares? Because if I'm in an accumulation phase of my investing career and I'm just trying to buy the S&P 500, if I'm just trying to accumulate Google stock, it doesn't fundamentally make sense for me to want to sell you my shares, because I want them for the long term. So when would it make sense for me to do something like this? Well, there's two ways you can look at it. The first is collecting the fees. A lot of people just want those premiums. They just want the fees. So the only time it would make sense to write covered calls are on assets that are likely not going to get called away from you, that you're not going to have to sell to the contract buyer. So you want to find things in industries where the market remains relatively flat, probably like oil, energy sector, anything where you can just find very stable, not a lot of movements in the stock price. So the other spectrum too is if I'm somebody that holds a lot of Google stock, and let's say it ballooned like it did and it ran up 50%, and I don't need to necessarily just sell my position to remove some of the risk from my portfolio. In fact, if I think Google is going to keep going up, I will sell a covered call contract on some of those shares in hopes that it gets called away, because if it does, I can limit my exposure and I can collect an extra fee, so I can make more money on top of the shares that I hold, while also, being comfortable selling those shares to just bring the weighting down a little bit. That's another strategy that you could implement. And on the other spectrum, there's something called cashed secured puts, and this is another one that none of these guys talk about, and it gets technical. You can go on Reddit, read about things called the wheel strategy, but fundamentally this is just the same thing in reverse. If there's a stock out there like Tesla that I like, and I would like to own Tesla, just not at this current price, I can get contracts that would allow me to buy them at say $200 or $300. So if it drops from the 400 to 300, I would want to buy it there, just like I want to buy Meta in the 500s. So I can actually collect a fee to have the right to buy those shares at a given price in the future, which is crazy. So if there's a stock you love, you have cash in the bank, and you're like, hey, I would love to buy this if it gets down to a certain price, somebody out there will be willing to give me that right. And that way I can collect money off a stock I love if I think it's overvalued and wait. And if it never comes to my price, at least I'm still making money off of it while I'm waiting. I hope that made fundamental sense. But let's talk about YieldMax. So understanding this, we can see why Google and AI is telling you no, you do not want to write covered calls on highly volatile assets like the holdings in ULTY, because again, you get all of the downside, right? Like you're taking the full downside risk, and this is supposed to be a high growth lottery ticket for people, but you're giving somebody the right to buy your lottery ticket when the lottery ticket wins. Does that make sense? Because if you take a look at ULTY as an example here, firstly, when you get volatile markets, sometimes they can't even get option contract premiums, so they're just returning your capital, 100% of your capital, and you're paying a manager a fat fee to do so. They're manipulating income-oriented investors that don't know any better by saying, I'm going to give you a 70% distribution. That is absurd. That means if I put 100 grand in here, I'm making a 70% return. That's the fallacy, the joke, and the manipulation, right? Because I can't get 70% returns. Warren Buffett can't get 70% returns. So why would you just promote on Blossom that you're making 30, 40, 50% returns? They don't talk about this, the annualized total return of your accounts, because my best account is doing almost 30%. My worst accounts are doing like 15 to 16%, which is closer to the market average, as the S&P has offered about 15% for the last 15 years. So it's crazy to me because they're returning a lot of times your own money. Like again, 0% return for the last dividend, guys. How much are you paying these people to give you your own money back when option premiums aren't available? A 1.4% fee, and your actual since inception return has been 14%, guys. I mean, you can see 1 year, 6 month, the returns are all over the place because of how damn volatile the underlying holdings are. And a lot of people like these stocks. I mean, you're talking about, things like Palantir and Coinbase and Robinhood. These are all lottery ticket stocks, Rocket Labs. Why would you want to sell these if you're a long investor toward them? And if you think they're overvalued, it isn't appropriate to do covered calls. You want to do cash secured puts. Again, there's nothing in the strategy of covered calls that makes any damn sense to own these. How much funds is ULTY managing? Like, what is their current NAV value? Can we just admire how much money this company has brought in? What are we sitting at today? Net assets. So you clowns have put $1.8 billion into this, and they're collecting a 1.4% fee. YieldMax is going to make a substantial more amount of money off this investment than you ever will. And again, I'm not trying to be crude. I know I'm hyperbolic here, guys, but I just don't want to see you lose. I want to see you get rich. I want to see you all have a great retirement, but you're following these people, that clearly never wrote a covered call in their life. They've never talked about a cash secured put. They have no strategy. They don't care about what they're buying, because if they did, they would not be doing it this way. And I don't know what else to say about it. I just think it's like a cult. It's literally a cult behind people that probably didn't save enough for retirement, that think there's a cheat code, and there's not. This isn't new, guys. It's been around for a while, and I'm sorry to say it if you're the one caught in this trap, but over the long term, you are severely going to regret what you're doing if this is the way you're approaching it. And don't get me wrong, I think there's a place in one's portfolio in retirement when they want to lean more toward cash flow to own a percentage of their portfolio with covered call ETFs. That doesn't mean make your entire portfolio covered calls, especially on highly volatile assets like passive income investing is buying. Because they are going to tell you, I'm long tech, I'm long AI, I'm long crypto. Then why are you giving somebody the right to buy your shares? Because what's going to end up happening, that just because you're not doing it, which doesn't make any sense to me, because they're like, I don't want us to have to sell shares. I'm a dividend investor. I shouldn't have to sell shares. So you're going to pay someone to sell those shares and buy the shares for you. Like, you're a clown. Just admit it. But I'll pass that question off to you. I'd love to know what you think in that comment section below.